Welcome to this week's The Week Ahead briefing by Genghis and FX Pesa. My name is Cecil Ogutu. I head the research team at Genghis Capital. Later on, I'll be joined by Mackley, who will take you through the global market segment. In case of any questions, please use the chat function. Yes. So I'll run you the equities and fixed income segment. I'll kick it off with the macroeconomic segment. Expectation for this week is it's quite heavy with the monetary policy decisions. I know that the biggest one will be the US Federal Reserve meeting, which will be today, tomorrow, and on Wednesday. Let me leave there before I steal the thunder from Mark's presentation. But back home, we know that CBK Monetary Policy Committee meeting on Wednesday. We've seen that in the COVID-19 period, there's been 1.25% slash on the CBR rate, the benchmark rate 7%. Also, the cash reserve ratio has been reduced by 1 cent to 4.25%. But that being the case, we don't see that there's been robust lending activities in the current environment. Although private sector credit growth was reported at 8.1% the month of May, we still feel it's more of a base effect. Remember that last year, private sector credit growth was at record lows, so this is just base effect that you're seeing. And we don't see that there's been robust extension of private sector credit in the current environment. That's also seen by the record levels of liquidity in the banking sector at the moment. At the tail end of this week, we are expecting to see the July inflation print. In the last 2 months, trend. This inflation basically means that inflation, which is being reported, is on a declining basis. We've seen it pan out in the months of April to June. And we've seen that core inflation, which is basically a pulse of the demand pressure in the economy, has been subdued at 1.6% over the month of June. That being the case, we still expect that the July inflation print will still remain at current levels, which is around 6%. The print will come out at the end of this week. Moving to the equities segment, the review of last week, the benchmark indices performance was quite mixed. Nairobi All-Share Index increased by 1.8% to 134.6 points, while the NSE 20 share index declined by 1.2% to 1,886 points last week. Turnover also declined 3.7% to 3.3 billion shillings over the course of last week. Foreigners still have an upper hand trading at the local bourse, participating to the tune of 67.5% over the course of last week. That said, there have been profit-taking activities by the foreigners on big names that Safaricom, BAT, Equity, and KCB Bank. And the total net outflows last week was 1.4 billion shillings. We still see that there still be some shortness in the market, uncertainty around COVID-19 numbers and also the policy around it. Today, the president is meeting the governors, and what will come out of that is this record, the high confirmed cases that have been come out of it. 3 weeks ago, we saw that the cessation of movement in some of the counties, Nairobi being one of them, and some of the coastal counties was lifted. And in that period, we've seen that the confirmed cases have been a rise, averaging 463 cases on a daily basis, July 6th to date. And of course, whatever the decision will come about, whether it could go back to where we were, or there could be some severe restrictions, this obviously will have an impact on the fundamentals on the stocks. And those are some of the things that investors are keeping an eye on. So moving on, TPS Serena is in the hospitality industry. It released its first half of this year's numbers last week. And we know that hospitality industry has been the hardest hit sector in the COVID-19 period. That one was reflected by revenues falling by 59% year on year to 1.1 billion, and also loss per share increased by 243% to 3.3 shillings and 3 cents in that period. The company also issued a profit warning. Remember that the first period, we saw that with tourism collapsing and there's no hotels were not fully operational, it had an impact on the numbers. And we don't expect that there could be a positive performance even in the second half period. So they also issued a profit warning based on that. So that is something that investors should also keep an eye on in the course of this week. Moving on to the corporate actions for the week, Scan Group, the book closure of a special dividend of 8 shillings is tomorrow. This special dividend arose when Scan Group disposed of its shareholding in Millward Brown East Africa, Millward Brown Nigeria, Millward Brown West Africa, and also Research and Marketing Group Investment Limited. The special dividend was 40% of the net proceeds from the sale of the shareholding. And what we are seeing is when the special dividend was announced early in the course of this month, the share was trading at 17 shillings. It closed last week at 19 shillings and 55 cents. That indicates we are still seeing that the market has already priced in this information. Remember that the time that this transaction was a time like this last year, at 1st of July, and the share was trading at 11 shillings and 5 cents. So some of the investors who came on to this trade, they already priced in this special dividend, and that's one of the things that we are not advocating at the moment. Trading on the dividend for Scan Group. The payment will be within the cost of 30 after this dividend book closure has come, so will be the course of the month of August. Second in line is Macroeconomic, which last week released its first half numbers. It announced a dividend payment of 10 shillings, and the book closure will be on Thursday. Finally, Safaricom has a dividend of 1 shillings and 40 cents. The book closure was announced on 31st of July. But that being the case, we are saying that the virtual AGM, which was expected to be on 31st of July, for that day. That's basically the holiday, Eid al-Adha, which is expected to be on Friday. So that could be one of the reasons why it was moved a day earlier. The dividend payment was expected to be on or about 1st of November, but that was also brought forward to that 1st of August, the payment of this dividend of 1 shillings and 40 cents. Finally, EABL is expected to release its full year 2020 earnings on Thursday, 30th of July. We recommend a buy at current levels, which is 160 shillings. The target price is 201 shillings and 68 cents. We expect, nonetheless, that the full year 2020 earnings per share numbers to decline by 26% year on year on the back of the weaker second half period. The second half period is basically January to June period, and this is basically with the closure of bars and social events, which has had an impact on the fundamentals of EABL. In particular, the business is heavily reliant on on-premise consumption, and the closure of bars has had an impact on EABL. Nonetheless, we still see it attractive on relative valuation metrics. Its price to earnings ratio is cheap at 13.4 times, while its peers is averaging 15.6 times, and its return on equity is elevated at 1.7%, so it's quite attractive, hence our buy recommendation. And looking at the fixed income segment, last week secondary market was up to the tune of 12%. week on week and closed at 12.9 billion shillings. Most of the trades that were executed were on the infrastructure bond segment. 5-year red July primary bond performance. CBK was seeking to raise 60 billion shillings from this. It received bids to the tune of 181 billion shillings, which is a performance rate of 303%. Basically, we are seeing what is colloquially known as FOMO, fear of missing out. Bids were elevated across all the three tenors, the 5-year, the 10-year, the 15-year tenors papers, and also this had an impact of the yields also were on a decline, the fear of missing out. But that said, we are seeing that this strategy, medium-term debt strategy, whereby Treasury is seeking to raise bonds on the longer-term space, playing out quite heavily. Out of the 80% of the bids were on the 15-year paper. So that just shows us how the Treasury debt strategy really weighed on this primary paper. Of course, we've seen that there's high liquidity in the market, which bolstered the uptake of the July primary bonds. That said, interbank rate edged up by 0.5% to 2.28% on a weekly basis. The volumes on the interbank market was at 1 billion shillings. On the other hand, repo market also edged up by 1.6% in the week to 4.7%. The volumes that were accepted, basically repo are, because of the high liquidity, now CBK is coming in to mop up the excess liquidity. So it managed to mop up 111.4 billion shillings over the course of last week on repo transactions. This had an impact of even supporting the Kenya shillings. At some point, midweek it was trading at 108.3, and it closed the week at 107.84 against the dollar. Our trade recommendation for this week is because we are seeing that 4 billion shillings was rejected on the 10-year paper. There are traders that were on last week's auction. 4 billion shillings was rejected on the 10-year paper, and we are seeing that most of these bids were positioning. People were just looking at that key segment of the yield curve. So what we are seeing is that people who are holding on their 10-year paper, the fourth 10-year paper, which was issued last year, which is formerly called FXD4 2019-10, to sell at 11.55% so that they can be able to accommodate the investors who are eyeing the 10-year segment. Over to you, Mark, to carry on with the remaining part of the presentation.
Thank you, Churchill. Just bear with me 1 second while I share my screen. Okay, so good morning, everybody, and welcome to our week ahead briefing. My name is Mark Lee. I'm a senior trader here at Equity Group and a market analyst for FX Pesa. So another busy week on the economic calendar. Let's take a look at a few of the highlights. As you can see, there's no shortage of three-star data scheduled for the week ahead. In around 45 to 40 minutes, we have German IFO business climate data. The index uses survey results from a number of key sectors, such as manufacturers, builders, retailers, etc. And the survey is used to gauge market sentiment across Germany. So it's going to impact the euro across the board, and of course, the DE30. For those who aren't familiar with the DE30 market, the DE30's underlying instrument is the DAX index. The DAX is a blue chip stock market index consisting of 30 major German companies that trade on the Frankfurt Stock Exchange. Companies such as Adidas, Deutsche Bank, Allianz, and others. A very popular trading product amongst our existing clientele. Then later today, we have core durable goods orders out of the US. And this reading will reflect the total value of new orders for long-lasting manufactured goods. So it's going to give us a good reflection of ordering trends and consequently manufacturing activity levels. Tuesday, we get US dollar CB consumer confidence data for July. Then in the early hours of Wednesday, we get CPI quarter on quarter out of Australia, a reading of negative 2% is expected. CPI stands for Consumer Price Index, and it measures the change in the prices of goods and services. So CPI and PPI, which is Producer Price Index, they're pivotal readings to gauge inflation. Inflation is the quantitative measure of the rate at which the average price level of a basket of selected goods increases over time. So for example, a $1 chocolate bar in the year 2000, that same chocolate bar, quality, quantity, etc., it may now be $1.75 due to the cost of inflation. The opposite being deflation, the decrease of prices over time. But why are they so important? Inflation dramatically impacts the decision making of central banks, hence why CPI and PPI figures carry such high importance for traders. Rising prices can eventually hurt consumer spending, and consumer spending traditionally equates for 2/3 of a nation's GDP. In this example of uncontrolled inflation, central banks are going to lift interest rates to control price gains, so higher interest rates, less borrowing ability, less consumer spending capacity, more incentive to save, etc. Central banks have a mandate to control inflation at a suitable level. For example, the Federal Reserve in the US, they have a target inflation rate of 2% annually. As policymakers, they're going to raise or lower interest rates as a mechanism to satisfy these target levels. A far cry from the current economic climate, but higher than expected CPI data signals a strong bias towards higher interest rates, and that's generally considered bullish for that domestic currency, wherever it be around the globe. We then have pending home sales out of America, as well as crude oil inventories, and that's going to give us an insight into the supply and demand dynamic of WTI, something we did touch on in last week's webinar. We then have the Fed interest rate decision, the Central Bank of America. The markets have priced in only a 5.9% chance of another interest rate cut. So it's widely anticipated that rates will remain unchanged at 0.25%. However, the FOMC press conference is going to dominate attention, and that's going to be the real source of volatility. Rhetoric from Fed Chairman Jay Powell is going to be heavily scrutinized. We've seen the dollar under pressure for a number of weeks and months now, and we did see a slight turnaround in US equities towards the back end of last week, so a very, very pivotal time for this press conference. We know market sentiment is still very fragile, and any sign of negativity from the Fed is going to translate into the market prices on our screens. The Fed are already running at full capacity, quantitative easing measures, rock bottom interest rates. They're running out of cards to play if economic conditions start to worsen, and that is really going to be where the panic starts to set in. Until the public are confident that this coronavirus disease is contained, then a full recovery across the board is very unlikely, in my opinion. At some stage, the Fed may be forced into negative interest rates for the first time in US history, and that's something Jay Powell has been very dismissive of in previous communication. So let's wait and see for further clues during Wednesday's meeting. Moving on to Thursday, we have employment and GDP data out of both Germany and the US. Last week's initial jobless claims data reflected a slowing labour market stateside. So let's see what Thursday's reading will project. On Friday, we have manufacturing data out of China, followed by European CPI and Canadian GDP. So a jam-packed trading week, which is sure to yield volatility. The highlight for me is Wednesday's FOMC press conference. I'll be carefully looking for any hints on future monetary policy and any projections from the most important and influential central bank in the world. We also have a big week in regard to corporate earnings. Tuesday, we have earnings from McDonald's and eBay, most notably. Wednesday, we have Facebook and Boeing, so two huge names, both of which have dominated the media spotlight of late, especially Boeing. It was only Friday that we learned of the FAA's investigation into 2,000 defective Boeing aircrafts. Thursday, we have Apple and Google-owned Alphabet, so two giants in the tech space. And that leads me into my trade of the week. So the UT100, I'm just going to pull my chart onto the screen so you can see it. So we're looking for UT100. I'm concentrating here on a weekly chart. The weekly chart has really captured my attention of late. So I'm just going to full screen this here, change to a weekly. As you can see on the chart here, looking at a weekly, there's a real sign of a temporary top, in my opinion. The chart also reflects what's known as a bearish engulfing pattern. So a strong uptrend, as you can see here, followed by a monthly down candle, and then a breach of that previous low again the following week. We've also seen such a strong rejection around this 11,000. We couldn't trade above it for a sustained period. So I'm going to be looking to sell with a stop loss above that previous high, hopefully targeting a reversal towards this 9,750 region. It's starting to look like an exhausted rally. One market that doesn't look exhausted is gold. So only hours ago, we saw gold posting record all-time highs, so quite astonishing. And we now enter unknown territory to an extent. We've never traded at these current levels. It's very difficult for market bears to identify opportune areas to sell, and once they sell, how do they manage their risk to the upside? It's very difficult without historical price action giving us any clues. And for that reason, I suspect gold bulls will continue to have the upper hand throughout the coming weeks. So a fascinating market of late, and one to keep a very close eye on for the trading week ahead. Remember, in the research and tools section on our website, you get all of the economic calendar. It's going to give you time, importance, the forecast number. So utilize all the tools available. Another great chart at the moment is Eurodollar. On a weekly chart, there's a real strong trend line. I'll just show you here. So we're looking for Eurodollar. So if you look on a monthly here, I'm really looking. This is a pivotal area for Eurodollar now. So euro against the dollar. As you can see, this downtrend has really respected that level. So let's see if we can break through it. And as we say, that resistance of the trend line, if we do break through it, that's going to be the first level of support in a bullish uptrend. That concludes this week's webinar. Thank you all for joining. Stay safe and good luck for the trading week ahead. Thank you.